A €130 billion deal is done. Eurozone finance ministers agree on the terms of new loans to Greece after over 13 hours of tense negotiations. And more than 20 countries meet in Moscow to try and pressurise the European Union into abandoning its carbon tax on airlines. Hello and a warm welcome. You with World Business Report. I'm Sally Bundock. Well, after an exhausting and mammoth meeting in Brussels, Eurozone finance ministers finally reached agreement on a second bailout package for Greece. The deal means the Greek government will receive another rescue fund worth €130 billion to prevent its economy from defaulting on its debts next month. But there are strict conditions attached, and some of the key points that have emerged are that ministers will be looking to see the Greek debt target of 121% of GDP by 2020. That's slightly above the target set by negotiators. To help Athens reach that, private bondholders agreed to accept a bigger loss on their investments of 53.5% or more. This debt exchange will help reduce Greece's debts by around €100 billion. And the European Central Bank will pass up profits it's made from buying Greek bonds over the past 2 years under its emergency bond buying programme. Well, the euro, as soon as the news was announced, did jump on the deal. That was the immediate reaction. I spoke to Yanis Varoufakis, who's Professor of Economics at the University of Athens, via webcam, to get his reaction to this news.
Depression at the sight of Europe remaining in deep denial over both the state of the Greek economy and the state of the Eurozone, I'm afraid.
So in terms of the detail on this, obviously the private bondholders, it looks like they're taking a fairly big hit, which is what was expected. The ECB taking a chunk of that as well. Obviously, this is all about reducing debt, which is a short-term fix, but the question about the long term.
Greece has now officially defaulted, but Europe has managed to find a euphemism for it. It is calling it a second bailout. The debt situation for any nation, for any state, depends on two numbers. One is the rate of interest at which it has to repay its new and old loans. And the other is the rate of growth. If those two numbers are very much out of sync with one another, then you have a disaster in your hands. At the moment, the interest paying will be anything between 3 and 4%, and Greek growth is minus 7%. This is what makes the whole deal unsustainable, and it's the reason why the Asian markets, quite understandably, are not impressed by it.
Well, that's one reaction to that story. We'll look at the market numbers later on in the programme.